Happy New Year, taxpayers, and it's that time of the year for me where on the 1st of January each year for about the last 5 or 6 years, I think it is, I've been outlining my forecasts for some key macroeconomic variables and a few market indicators. And after a pretty solid year last year, which I posted about earlier, so just check on the feed to see the assessment of the economic and market success and failures, it should be noted. Of course, here's a stab at 2026. So, GDP growth. Look, I think we've got a bit more upside momentum in the first part of 2026. And then I think with the RBA being stubborn at this stage in terms of its monetary policy settings, global growth probably slowing. We'll have a bit of a cooling in the second half of 2026. GDP growth, kicking along at around 2.5% in the first half of the year, probably 2% or less in the second half. Because of that, the unemployment rate continues to creep up. Obviously, last year we saw about a 0.5 percentage point increase in the unemployment rate on the back of a soggy economy. Another 0.5 percentage point increase during the course of 2026 is the key forecast. The job ads series are really pointing that way, and goodness knows whether the job ads are actually reflecting true demand for labour, because we are seeing some, quirks in some of the other labour advertising numbers, of course. So with unemployment creeping up, the economy cooling back down, inflation will fall as soon as we get these administered prices dropping out of the run rate. And I don't think we're going to be seeing any more increases in public transport fares, or many increases. The electricity subsidies washing through, childcare subsidy ending, and these sorts of things which have been contributing a lot to that September quarter inflation boost. Once they wash out, I think we're going to get the inflation rate easing back to that sort of 2 to 2.25% level by the time we get to the end of 2026. And because of that and the weak labour market, wages growth will continue to be soggy, holding around 3%, particularly for the private sector. So again, that wage price spiral that the RBA and some others fear will just not be there. RBA will end the year with a cash rate at 3.1, currently 3.6%. Now, obviously, a lot of the discussion is, will they hike rates in February or early in the new year? They may, but if they do, it'll be an error, and they'll quickly have to rectify that with rate cuts later in the year. So it's more a call on where rates will end the year, and I'm going for 50 basis points lower than when they started the year, so down at 3.1%. 10-year bonds, my gosh, they're cheap as chips right now in Australia. We're getting to about 4.75%. Extraordinary levels given the fundamentals of the budget, of the momentum in the economy, these sorts of things, the relative lack of supply. I think they're due for a rally. They're massively oversold, and 4% for the 10-year yields at least a minimum target for me by the end of the year. Aussie dollar, obviously my best friend last year, is actually kicking higher again. Look for the US dollar capitulation to occur as the Trump policy failures become more and more acute. I see a 75 cents, maybe even higher by the end of the year. So that's about a 7-8 cent increase during the course of this year. We might get there a little earlier, depending what happens to the big dollar. House prices, I got that wrong last year. I thought they'd be falling. Now, there seems to be a lack of momentum in house prices at the end of 2025. Auction clearance rates down in Sydney, Melbourne prices down a smidge. Look, I think we're going to be in for a period where house prices are pretty flat through the course of this year, maybe with some downside risk too. Higher unemployment is not good for house prices, and I think we are getting some supply side. We are getting, I'm assuming, lower immigration intake, so that demand supply pressure will put a bit of a dampener on house prices. So basically, no change in house prices in 2026. And the ASX looks very vulnerable, obviously linked to the US. I think the US stock market's heading for a pretty sizable crap out at some stage. Like last year, when my target for the ASX was hit in April. Look, I've got a figure well below 8,000 points, so sort of like at some stage during the year, a 10% pullback. The shares are pretty expensive right now. There's still a lot of buoyancy coming from overseas, but that can change very quickly. So by the end of the year, or through the course of this year, I should say, we're going to be seeing ASX sub 8,000 at some stage. So that's it. We'll see how we go. Looking forward to seeing everybody else's forecast, particularly those who feel compelled to comment on my forecasts if they don't understand them. But go for it, have a look at them, and a happy new year. May all of your investments make you plenty of money.